Welcome back to the Deep Dive. It is Thursday, February 19th, 2026.
Yeah.
And I have to be honest with you, looking at the markets this morning, I almost fell asleep at my desk. It is just so quiet out there.
It is.
But then I looked at the research stack you brought in, specifically this interview on network security, and suddenly I'm wide awake and maybe a little terrified.
It's a classic case of cognitive dissonance today. I mean, on one hand, you have a market that is essentially in a coma.
Right.
Low volume, sideways chopping, just bleeding out. But on the other hand, if you look at the technological horizon, there is a monster approaching that makes daily price action look completely irrelevant. We're talking about quantum computing.
Yeah. So we're pivoting from why is Bitcoin moving sideways to will supercomputer break the very encryption that holds the entire internet together pretty quickly today.
We are. But look, the goal isn't to induce panic. It's to separate the noise, which is that daily price fluctuation, from the signal. And the signal is the structural reality of where this industry is going. So we've got sentiment reports. We have Benjamin Cowan's latest cycle analysis on why this boredom was predictable. And we have a very technical breakdown from quantum expert Yuna.
Plus, we need to talk about ETH Denver. Because while the charts are totally flat, apparently the attendance numbers at one of the biggest crypto conferences on earth have.
Yeah.
Well, they've fallen off a cliff.
Yeah.
So let's start with the immediate pain. Let's talk about the bear market blues.
Blues is, putting it lightly, Benjamin Cowan has been tracking this, and the vibe right now in February 2026, it's distinct. It's not panic.
No.
It's not the chaos of a crash where everyone is screaming on Twitter. It's apathy.
Which feels worse, honestly. A crash is exciting, you get volatility. This is just nothing.
Cowan calls it the slow bleed.
The slow bleed.
Yeah. And if you look at the trading sessions, specifically during U.S. hours, the volume has evaporated. The ETFs, which everyone thought would be this permanent backstop for price,
It's a safety net, right.
they're actually seeing consistent outflows. But here is the nuance. It's not a dump. It's just a lack of a bid.
Okay, but why? I mean, we are 2 years past the halving. Usually the narrative is up only by now. Why are we so stuck in the mud?
Because we ignored history. Cowan's analysis points directly to this concept of the midterm year. If you strip away all the narratives and just look at the 4-year cycle, 2026 is the midterm year, look at 2014, look at 2018, look at 2022.
More red years, every single barrel.
Brutal years. And 2026 is tracking strictly to that historical norm. You know, we often trick ourselves into thinking this time is different because of institutions or ETFs, but the liquidity cycle, that hasn't changed. Cowan points to a specific fractal from 2019, that pre-COVID market structure.
I remember 2019. It was a grind.
It was. And mathematically, the structure is almost identical. We're seeing Bitcoin hug the 20-week SMA, the simple moving average, and it's acting as resistance.
Right.
Every time it tries to pop its head above water, it just gets swatted right back down. It's a compression pattern. And usually when volatility compresses this tight for this long,
it leads to a violent expansion.
Exactly.
And in a midterm year, that expansion is usually down.
Historically, yes. The path of least resistance is lower. And this triggers what Cowan calls the rotation of risk.
I've heard this described as a waterfall. Is that a good way to think about it?
That's a perfect visualization. When liquidity dries up, it retreats from the riskiest assets first. So the money bleeds out of altcoins, your speculative tokens, your meme coins, and it flows into Bitcoin.
Which explains why the Bitcoin dominance chart is climbing even when the price is dropping.
Exactly. The alts are getting crushed against Bitcoin. Then, as the fear grips Bitcoin holders, that capital bleeds into equities. And finally, if the macro environment gets really scary, it bleeds from equities into gold and the dollar.
So if you're holding a bag of random altcoins right now, hoping for alt season,
you are fighting the current of a very, very steep waterfall. The liquidity just isn't there to support those speculative assets.
All right, give it to me straight. When does the bleeding stop? Because Cowan usually has a timeline for this stuff.
He does, and you might not like it. His forecast suggests weakness continuing through late February.
Okay.
We might see a dead cat bounce in early March. Just enough to get people excited again before a renewed leg down in April and May.
Oh, wow. That's months of this.
A potential local low could form in May, but, and this is the kicker, if we follow the 2014 and 2018 cycle analogs perfectly, the true cycle bottom for this whole correction might not hit until October 2026.
October. So we're basically writing off the entire summer?
Unless the macro environment shifts dramatically. And that brings us to the why. because the charts at the end of the day are just a reflection of human psychology and capital flow. So what is draining all the liquidity?
This is where we get into the geopolitical stuff. And frankly, looking at the sources, it feels like the whole world is on edge right now.
It is. And markets hate uncertainty more than they hate bad news. There's this fascinating, albeit grim, indicator mentioned in the report, the flight radar watchers on X.
I saw this. People are literally tracking military transport planes in real time as a way to trade crypto.
It sounds dystopian, doesn't it?
Yeah.
But it's surprisingly effective. We've seen a significant uptick in U.S. military heavy transport activity, all heading toward the Middle East. Now, we don't know the mission profiles.
Right, it could be anything.
It could be routine logistics, but in a low-volume market, perception is reality.
So a trader sees a C-17 Globemaster heading to the Middle East, they assume escalation, and they just hit the sell button.
Precisely. It creates a risk-off environment. Capital flees to safety. And safety right now, ironically enough, is the U.S. dollar.
Which brings us to the DXY, the dollar currency index. We always say dollar up, crypto down. But is it really that simple?
It's all about the mechanism. The DXY isn't just a number. It's a measure of global collateral. And right now, the DXY is bouncing hard off a multi-year support trend line. It defended that 101 level and is pushing back toward 106.
And for the listener who doesn't stare at currency charts all day, why is a 106 a nightmare number for us?
Because the entire global financial system is built on dollar-denominated debt. When the dollar gets that strong, it acts like a liquidity vacuum.
Sucks it all up.
It sucks it all up. Emerging markets, tech stocks, crypto, they all get starved of oxygen because everyone needs dollars just to service their debts. You mathematically cannot have a sustained crypto bull run when the DXY is ripping higher. It's like trying to light a match in a vacuum chamber.
So we have a cycle downturn, geopolitical fear, and a dollar squeeze. It's the perfect storm for boredom and pain.
It is.
But, and here's where I want to challenge the narrative a bit. If the industry is so dead, why is anyone still building anything?
That is the right question. Price is a liar. Price tells you what people feel today. Development tells you what the value will be tomorrow.
Okay, so let's talk about ETH Denver. This is usually the big party, the Super Bowl for Ethereum. But the stats you pulled, I mean, 25,000 attendees in the boom years, down to an expected 8,000 to 10,000 this year. That sounds like a funeral.
If you're a VC looking for hype, yeah, it probably looks like a funeral. That's a 60% drop.
Yeah.
But I want to quote Russell Castanero here because he framed it perfectly.
Okay.
He said, people used to come because they had to be seen. Now they come because they want to get something done.
So the influencers all stayed home.
The influencers, the grifters, the people who were selling monkey JPEGs, they are gone. They don't fly to Denver in February to freeze their toes off unless there's easy money on the table.
Right.
But the 8,000 people who are there, they are the ones writing the code.
So it's a filter. The bear market filtered out all of the noise.
It's a builder's market. And we are seeing concrete evidence of that. Look at the headlines we pulled. This isn't just some theoretical building. Look at Robinhood.
Robinhood is an interesting one because they are traditionally a retail stock app. But their layer 2 testnet just hit 4 million transactions in a single week.
4 million. That is significant volume. They're building on the Arbitrum stack, integrating directly into the DeFi ecosystem. This tells you that while retail traders are bored, the infrastructure for the next wave is being laid down right now.
And then there's Coinbase's chain. They made a pretty dense technical announcement about moving away from the Optimism stack. What does that actually mean? I thought being part of the superchain was the whole goal.
It is, but Base is maturing. They are moving to a unified Base-operated client with new proof systems. In plain English, they are taking the training wheels off. They're customizing the engine to run faster and more securely for their specific needs, rather than just using the out-of-the-box software that Optimism provides. It's a sign that these networks are becoming robust enough to stand on their own 2 feet.
And maybe the biggest signal of smart money positioning comes from Wall Street. Did you see the David Solomon news?
The Goldman Sachs CEO?
The guy who spent years basically saying Bitcoin was for criminals and tulips.
And now reports are confirming he personally owns a small amount of Bitcoin.
Which, knowing Goldman probably isn't that small.
Probably not.
Yeah.
But the symbolism is what really matters. When the CEO of Goldman Sachs is allocating his own personal capital during a boring, bleeding bear market, it tells you that the whole crypto is dead narrative is just theater.
Yeah.
He knows the asset class isn't going away.
He's buying the dip while telling everyone else to be careful.
Classic. Watch what they do, not what they say.
Okay, so we've established that the market is asleep, but the builders are wide awake. But now I want to pivot to something that might keep everyone awake at night, the existential threat.
The quantum deep dive.
We looked at an interview with Paul Barron and Yun Ah, a quantum computing expert. Now, usually when people bring up quantum and crypto, I kind of roll my eyes. It feels like sci-fi FUD. Oh, the magic computer will steal all the Bitcoin.
Right.
But Yun Ah, he didn't sound like he was fear-mongering. He sounded like an engineer describing a structural flaw in a bridge.
That's a great way to put it. We need to move past this idea of a magic computer and actually understand the math. The threat is specifically about public key cryptography, the ECDSA signatures that secure Bitcoin and Ethereum.
Right. The lock on your wallet.
Exactly.
Yeah.
And currently, that lock is secure because it would take a classical supercomputer billions of years to guess your private key from your public key. But Shor's algorithm, which is the math that quantum computers use, can solve that specific problem exponentially faster. We aren't there yet hardware-wise, but the vulnerability gap is real.
And you now made a really interesting point about why crypto is more exposed than, say, Chase Bank. Because I always assumed banks would be the first target.
You'd think so, but banks are centralized. And that's actually their superpower in this scenario.
Yeah.
If Chase realizes their encryption is broken, they just pull the plug, they shut down the server, they install a software patch behind a firewall, and they turn it back on. You might not be able to access your account for 12 hours, but your money is safe.
Because there's a guy in a room who can just hit stop.
Exactly. But crypto, it's decentralized. There is no stop button. The ledger is public. Your public key is visible to everyone on the blockchain. If a bad actor has a quantum computer, they can just attack the blockchain and no one can unilaterally stop them.
That's terrifying. So if they can derive my private key from the public ledger, they can just sign a transaction and empty my wallet.
Correct.
So why aren't we fixing this now? If we know this threat is coming, why isn't Bitcoin upgrading to quantum-resistant code today?
This is where the deep dive gets really technical and fascinating. It's not about laziness, it's about trade-offs. Yun explains that we have the math. We have post-quantum cryptography, like lattice-based signatures. But there is a catch.
There's always a catch.
The catch is weight.
Weight.
Data weight. Current crypto signatures are incredibly light. They're just these tiny strings of data.
Okay.
That's important because block space is expensive. You want to fit as many transactions into a block as possible.
Yeah.
Post-quantum signatures are massive. We are talking about data sizes that are 10x, maybe even 100x larger than what we use now.
Oh, wow. So if we upgraded Ethereum to use these new keys today,
the network would grind to a halt. Gas fees would skyrocket to hundreds, maybe thousands of dollars per transaction because each one is taking up so much space in the block. It would make the chain economically unviable.
So we're stuck between a rock and a hard place. If we don't upgrade, we get hacked by the future. If we do upgrade, we break the entire economy of the chain today.
That is the dilemma. And that is why the builders at places like ETH Denver matter so much. They aren't just trying to lower fees for today. They are trying to figure out how to scale the network capacity by 1,000x so that it can handle these heavy quantum-resistant keys when the time finally comes.
It changes how you look at scalability. It's not just about fitting more coffee purchases on the blockchain. It's about having enough bandwidth to carry the armor we're going to need in 2030.
Precisely. And this leads to Yunao's main conclusion. The winners of the next decade won't necessarily be the chains that are the fastest right now. They will be the chains that are the most agile.
Agility. That's not a word we usually use with code as law blockchains.
We love the word immutable.
Yeah.
We love saying Bitcoin never changes. But in a biological sense, if a species cannot change when the environment changes, it goes extinct.
So immutability might actually be a death sentence in a post-quantum world.
It could be. The future might belong to protocols that can embrace cryptographic agility, the ability to hot swap encryption standards without forking the entire network into oblivion. Or maybe hybrid models, where you pay a premium for a quantum-safe transaction for your life savings, but use standard encryption for your daily coffee.
You get to choose your own security adventure.
In a way, yeah. But it requires a huge mindset shift. We have to stop viewing change as a bug and start viewing it as a survival mechanism.
That is a heavy concept to land on. We started with the market is boring and ended with adapt or die.
That's the nature of this industry, right? The boredom is just the surface layer. Underneath, the tectonic plates are always moving.
So let's wrap this up for you. We are in a painful, boring historical lull, the midterm blues. That's the Cowan thesis.
driven by macro headwinds, the geopolitics and the dollar vacuum that make a rally mathematically difficult in the short term.
But if you look past the price, the tourists has left the building and the locals are upgrading the infrastructure at a really rapid pace.
And looking even further out, the smartest minds are already preparing for the quantum epoch, realizing that the only way to preserve value for a century is to build systems that can actually evolve.
So if you're checking the charts every 5 minutes, just stop. You're going to stress yourself out. The real action is happening in the code, not in the candles.
Couldn't have said it better myself. Use the downtime to learn. Use the boredom to study.
And maybe read up on lattice cryptography if you really want to impress your friends at parties.
Or scare them.
Or scare them. Probably that. All right, that's it for today's deep dive. Stay curious, keep building, and we'll catch you next time.